I want to kick it off then with that triple R move from China. Is this really about steadying liquidity in China, or is this really part of a wider tit-for-tat between the United States and China, not just in terms of trade tensions, but also in terms of competitive devaluation? Quantify for us in terms of the likelihood of further escalation here.
Well, I think you can read, obviously, the move by the central bank in that way, but I think it's basically our view that this is not intentionally driven to sort of add fuel to the fire of the trade tensions between the two nations. Rather, I think it was simply a move, given some of the data has been a little bit more mixed than positively surprising in that country, and perhaps a way to kind of ease the conditions that they're seeing within China right now. So we would interpret a bit differently. We don't think that this is politically driven necessarily, but rather an adjustment they're making in the monetary framework to reflect current economic conditions within China.
Kathy, good to see you this morning. Timely to have you here. We're going to delve a little bit deeper into the whole Abe, the theatre of Abe and Trump a little bit later. But staying with currencies, one of the things that the markets have focused on is the lack of volatility in dollar yen. But when it comes to the yuan, one of the things that the market is talking about is maybe that China would use that as an instrument. How much risk is that in your mind, and what are the repercussions for Japan in that text?
I mean, again, a lot of speculation surrounding that issue, given the kind of overall global context that we are in vis-a-vis trade, especially bilateral trade between China and the United States. But as you heard earlier this week from the Chinese government official, basically emphasizing or stressing that there is no intention to devalue the renminbi in order to make Chinese exports more competitive globally. We're pretty much in that camp. We do not think that that would be something, at least, that they would think about seriously in the very near term. Of course, people could theorize and think that that's a very tempting move on behalf of the Chinese, given what the U.S. government has been coming out with in recent weeks. But it is our view that that is not the priority of the Chinese government at this point in time.
Kathy, we had the Fed's John Williams. He came out and talked a little bit about what has been a very contentious subject over the last few months, the issue of the inverted yield curve. And we've put this up on the GTV because there are some powerful signals that are emerging when it comes to U.S. two-year paper, and specifically the spread between 2- and 10-year U.S. Treasury yields at the narrowest in over a decade. And our clients can pull this up easily at GTV Go. As the yield curve continues to flatten, Kathy, I mean, what are the repercussions outside of U.S. borders? How do you look at that story?
Well, of course, again, macro theory would suggest that if we are heading into an inverted yield curve situation in the United States, that could send some signals that the U.S. economy that's enjoyed a very prolonged period of expansion could be entering a phase of slower growth or something more ominous down the road. That is, at this point, not our house view. We believe, yes, some of the data coming out of the United States has been a little bit more mixed than it has been in recent quarters. But if you look through the course of the last few weeks, overall activity in the United States economy still looks to be robust enough to us to prevent an outright and prolonged inversion of that yield curve. And so we think for the global economy, that suggests that the U.S. will continue to grow, will continue to see a tick up in inflation. And as a result, that is exactly why our U.S. colleagues are calling for a more hawkish than consensus view on the pace of tightening by the Fed going forward. If, of course, we're wrong, and that is indeed an inversion that we're heading towards, and that signals the U.S. economy heading into a recession, then of course that is pretty unanimously negative for the entire global economy. But again, that is not our main scenario at this point.
If we look at the marketplace and we look at Abe, I mean, he's gone to the United States. He needs some kind of message of victory for him there, because his ratings are plummeting into danger territory back at home. What does that mean for markets?
Well, exactly as you put it, he's looking for this trip to hopefully remind his constituents at home here in Japan that this U.S.-Japan bilateral alliance remains very strong, very healthy, and is hopeful that that will help shore up his declining support rate back here. Obviously, the obstacles are pretty high. Especially on the trade front, as we just saw in that tweet that was just quoted earlier. It does not appear that the U.S. is ready to jump back into TPP negotiations anytime soon. So I think at best, what the Japanese government is going to try to convince the U.S. and the U.S. president is to allow Japan to be exempt from the steel and aluminum tariffs that were recently announced, and to ensure that Japan remains on kind of the good side of the trade agenda going forward. Again, I think that's going to be a tough discussion, a tough hurdle, but that I think is one goal. And the other goal, of course, is to extract, again, some reassurance from the U.S. government that in these upcoming negotiations between the United States and North Korea, that Japan's self-interest, Japan's place in the geopolitical arena in Northeast Asia is also going to be secure. So there are sort of two prongs to the wish list, if I put it that way. And I think, again, it's not an easy battle for Abe to fight, but he's going to try to do his best because, as you said, his support rate does need some help.
Kathy, inflation is showing signs of building up in Japan. I mean, it is taking root. Price pressures are mounting, and they're getting closer to their 2% target. They're, halfway there roughly as we speak. This really puts the BOJ in an interesting position and perhaps opens a wider conversation about how an exit strategy would look like. How do you think the BOJ is going to approach that?
So the tricky thing with this whole topic is, of course, there are many measures of inflation here, and it appears that the preferred measure from the bank is not the regular core CPI ex food and energy, but rather what they call the new core metric, which excludes energy from that measurement. So, in fact, core inflation, the new core measure, does not show inflation ticking up that strongly just yet. Given that Kuroda has seen his term extended for another 5 years to 2023, I think the view from him and the bank right now is that it would be premature to start even mentioning the tapering process when inflation is still pretty far away from their goals. So in contrast to what the Fed is doing in the United States, to ECB's position in Europe, I think Japan, amongst the developed economies, is still probably in last place when it comes to where they are in position vis-a-vis tapering. I think also a consideration, importantly, of course, is where dollar yen has been trading. I know now it's in the 107 handle, but just a few days ago it was still kind of in the 105, 106 range. And that, I think, makes it even more difficult for the bank to talk openly about the possibility of tapering anytime soon. At the same time, you're right that inflation is ticking up. I would argue particularly because wages are finally beginning to grow more meaningfully, reflecting the very tight situation in Japan's labor market. But again, other areas of the CPI basket are still lagging behind. So I think in this overall mix of inflation, yes, it's improving slowly, but still far away from what would trigger the BOJ to start seriously the tapering discussion.
Kathy, I know that you were visceral in your cut just a couple of weeks ago. You cut your TOPIX target by 5.6% to 1,700. You just mentioned dollar yen, and I suppose the question is this. Is one of the biggest headwinds Abe or dollar yen? Is yen priced for the dysfunctionality of the global economy at the moment between Trump, between trade wars, between tariffs? Is dollar yen sufficiently priced for that risk? And is that the biggest headwind?
It's a good question. I mean, we think our FX team does think that if the U.S. Federal Reserve is going to be more hawkish than the consensus expects, and like I just said, the BOJ is going to be kind of easy for longer in their stance, simply looking at the interest rate differential between the two nations would suggest the yen should be actually a little bit weaker. If, however, we paint a different scenario whereby global growth it becomes more rocky, or there's more geopolitical / domestic political upheaval or turmoil, then of course the dollar yen may not be priced appropriately for that kind of scenario. But for the time being, our house view is what I just outlined, that the Fed is going to be hiking faster than the market expects, BOJ basically on hold. And at the same time, yes, there's domestic political uncertainty, and of course that will create some volatility. But overall, we don't think that the yen is seriously mispriced compared to our kind of longer-term fair trade model, fair value models. For companies going into earnings season over the next few weeks, that will be very critical to watch. As you know, Japanese companies tend to be conservative in their earnings guidance, and I think this year is going to be no exception. So on top of that, typically conservative guidance, then we have some strength of the yen. That would, of course, spell some near-term caution, I think, for the market, which is exactly why we cut our forecast near-term a few weeks ago.